You already know price stops at flat floors and ceilings, but markets trend, and when they do, support and resistance start to slope. The diagonal line that catches those rising lows or caps those falling highs is called a trend line, and a pair of them forms a channel, a sloping lane that price travels inside. Trend lines are how you read support and resistance in a moving market, and they are one of the most useful tools you can draw on a chart. In the next few minutes you will learn how to draw a valid one, why price respects it, how to use the channel, and how to trade the break on 3 real stocks, one step at a time. Before any real chart, here is the whole idea on one simple diagram. If you understand this picture, every trending chart after it will feel easy. First, how do you actually draw a trend line? Look at this rising market. It does not go straight up, it climbs in steps, pulling back to make a series of higher lows. A trend line just connects those lows. You find 2 points where price dipped and turned back up, and you draw a straight line through them, extending it out to the right. In an uptrend you connect the rising lows, like here. In a downtrend you flip it. You connect the falling highs along the top instead. That is the entire drawing rule. Now, why does that sloped line actually work? This is the part that matters, so let us slow down. It is the exact same idea as a flat floor, just tilted. Each time price falls back to the line, buyers step in and push it up again. But because the trend is rising, they are willing to buy a little higher each time. So the line becomes diagonal support, a moving floor that climbs with the trend. In a downtrend it is the mirror image, a diagonal ceiling where sellers step in a little lower each time, capping every bounce. Here is the rule that keeps you honest. It takes 2 touches to draw the line, but you wait for the 3rd touch to trust it. Any 2 points can be connected by a line. That proves nothing. It is when price comes back a 3rd time and respects the line again that you know it is real and that other traders are watching it too. 2 points draw it, the 3rd point confirms it. Now we add the channel. Very often, once you have your trend line, you can draw a second line parallel to it on the other side of price, touching the highs if your main line is under the lows. Those 2 parallel lines form a channel T, a sloping lane that price travels inside. And a channel is a gift, because it gives you both sides of the trade. You buy near the lower rail when price bounces, and you take profit near the upper rail when price stalls. And finally, the break. A trend line is not forever. Eventually price stops respecting it. Watch the end of the diagram. Price drifts down, and instead of bouncing, it closes clearly through the line. That close is your signal that the trend is changing, and just like a flat level, the broken line often flips. The old rising support becomes resistance when price tries to climb back to it. Draw it, trade inside it, and respect the break. That is the entire foundation. Now let us read it on 3 real stocks. Our first example is the most common and most useful, an uptrend line that holds and price bounces off it. This is NVDA climbing through April and into May. We read every trending chart the same way. Find the rising lows first, draw the line through them, then watch how price behaves at it. So step 1, find the points. Back at the end of March, NVIDIA bottomed near 164 and turned up. That is our first swing low, point 1. Then it rallied, pulled back, and made a higher low in early May, near 195. It did not fall as far before buyers stepped in again. That higher low is point 2. Now we connect those 2 lows with a straight line and extend it to the right. Notice the line slopes upward. It is not flat. That slope is the whole point. This is support that rises with the trend, a moving floor instead of a fixed one. But remember the rule, 2 points only draw the line. We need a 3rd touch to trust it. So watch what happens right after. Price dips back down to the line one more time, touches it, and immediately bounces. That is the 3rd touch, and it is the confirmation. The line is real, buyers are defending it, and now we can lean on it. And here is the payoff. Every time price returns to that rising line, buyers step in a little higher than before and lift it. So the trend keeps climbing along the line, carrying NVIDIA from 195 all the way up toward 236. That is diagonal support in action. As long as price keeps making higher lows that respect the line, the uptrend is healthy, and you stay with it. The first skill is simply drawing that line and trusting the bounce. Our second example adds the second rail and turns a trend line into a channel. This is Amazon, grinding higher through late February and March. We start exactly like before. Find the rising lows and draw the trend line. Amazon made a low near 196 in mid-February, then a slightly higher low near 200 at the end of March. Connect those 2 and extend the line. There is our lower rail, the diagonal support holding price up. Now here is the new move. Instead of stopping there, we draw a second line parallel to the first, the same slope, but slid up to sit along the highs. You can see price kept stalling around 213, so the upper rail runs right across those peaks. Those 2 parallel lines are the channel, a clean, sloping lane that price has been traveling inside for weeks. And this is why a channel is so useful. It hands you both sides of the trade. Watch the lower rail every time price drifts down to it. Buyers defend it and push price back up. That bounce off the lower rail is your place to buy, with the trend right where support sits. Then watch the upper rail. As price rises across the channel and reaches that ceiling line, it runs out of steam and stalls. Sellers step in there every time. That stall at the upper rail is your place to take profit or to tighten your stop. Buy low rail, sell high rail, and repeat. As long as price keeps respecting both lines, the channel is your map. The moment price breaks out of either side, the channel is done, and that is the next thing we look at. Our third example shows the other side of the story. What happens when a trend line finally gives way? This is Uber, and it starts with a textbook rising line. First, the line itself, and notice it is a strong one. Uber made a low near 68.5 in late March, then a higher low in the middle of April, then another higher low at the end of April near 73. 3 rising lows all lining up. We connect them and extend the line. This is a valid trend line with 3 clean touches, so we trust it. For 6 weeks, it was perfect diagonal support. Every dip to the line got bought and price climbed, but no line lasts forever, so we watch for the moment it stops working. In the middle of May, price drifts back down toward the line. Except this time, instead of bouncing cleanly off it and powering up, it just hangs there struggling, pressing against the underside of the line. That is the warning sign. Price is testing the line from below and cannot get back above it, and then it breaks. On May 19th, Uber closes clearly below the rising line. Not a quick poke, a real daily close underneath. That close is the signal. The higher lows have stopped. The buyers who defended that line for 6 weeks are gone. And notice the role reversal we talked about. That broken support line now acts as resistance, capping price every time it tries to climb back. From there, the trend simply rolls over. With the line broken and flipped, there is nothing holding price up, and Uber slides from the mid-70s back down to around 70. That is the trend line break. When price closes through the line, the trend that built it is changing, and that broken line becomes your new ceiling. Respect the break, and you step aside before the slide. Let us lock the whole thing into one simple checklist you can screenshot and run on any trending chart. Just 5 lines. 1. Use the right points. In an uptrend, you connect the swing lows along the bottom. In a downtrend, you connect the swing highs along the top. Lows for up, highs for down. 2 touches to draw it, 3 to trust it. Any 2 points make a line, so 2 is just a guess. Wait for price to come back a third time and respect the line before you lean on it. 3. Never force the line. This is the mistake everyone makes. Do not tilt or stretch it just to make it touch. If your line has to slice straight through candle bodies to connect the points, it is not a real line. Let the price pick the angle, not your wish. 4. Add the channel. Once your trend line is set, try a parallel rail on the other side. If price respects it too, you now have a lane and both sides to trade. 5. A close breaks it. 1 wick poking through means nothing, but a full candle closing on the other side of the line tells you the trend is changing. And remember, the broken line usually flips and becomes resistance or support on the way back. That is it. Right points, 2 to draw and 3 to trust. Never force. Add the channel and respect the closing break. Run those 5 checks and a trending chart will never look random again. If this made it click, subscribe. We build a new skill from the ground up every week. And that is trend lines and channels, support and resistance for a moving market. A trend line is just a sloped floor or ceiling. Connect the swing lows in an uptrend or the swing highs in a downtrend. Trust it. Once a third touch confirms it, trade inside the channel and step aside when price closes through. Here is your homework. Open any trending chart and draw the line where price has turned more than once. Find a line that held and bounced, then add a parallel rail and see if you have a channel, and find one that broke, and watch how it flipped to the other side. Do that on 10 charts this week, and reading trends will become second nature. If this gave you the foundation, subscribe. We build the next skill from the ground up every single week. See you in the next one.